A 0.47% fee difference doesn't sound like much, but over 30 years, it costs you over $100,000 in lost wealth. And most investors have absolutely no idea this is happening inside their portfolio. Welcome back to Wealth Blueprint. I'm your host, and today we're doing something most finance channels won't do. We're actually doing the math on expense ratios and showing you exactly how fees compound into generational wealth theft. Let's start with a question. Do you know the expense ratio of every ETF you own? Don't answer out loud, just think about it. If you hesitated, you're in the majority, and that hesitation is costing you serious money. Here's the scenario that plays out thousands of times a day. An investor opens a brokerage account. They decide dividend ETFs are the move. They search for best dividend ETF. They see three options. Option A, Vanguard High Dividend Yield ETF. Ticker VYM, expense ratio 0.08%. Option B, Schwab US Dividend Equity ETF, expense ratio 0.06%. Option C, an actively managed dividend fund from their bank, expense ratio 0.55%. Most people pick based on brand name or past performance. Almost nobody picks based on fees. But here's where it gets dangerous. Let's say you invest $100,000 today into a dividend ETF portfolio. You're targeting a 5% annual dividend yield. You reinvest all dividends. You don't add another dollar for 30 years. Just set it and forget it. Hypothetical 7% average annual returns. Fees are the variable. Scenario 1. You pick the actively managed fund at 0.55% expense ratio. After 30 years, your $100,000 becomes $761,225. You paid $847 in total fees over the 30-year period. Wait, no, that's wrong. Let me recalculate. You actually paid far more than that because the fee is charged every single year on an exponentially growing balance. Your net gain after all fees, $661,225. Scenario 2. You pick the low-cost option at 0.08% expense ratio. Same $100,000, same 7% annual returns before fees. After 30 years, your balance is $761,225 before fees, but your net gain after fees, $753,096. Do you see what just happened? Scenario 1 left you with $661,225. Scenario 2 left you with $753,096. That's a difference of $92,671. $92,000. Gone, vaporized by fees. And the only difference was 0.47% in annual expenses. Let that sink in for a second. Now, some of you are thinking, okay, that's a lot of money, but it's not the end of the world. I can recover from that. Wrong. Because that $92,671 difference isn't just lost. It's a loss that compounds and multiplies in ways most people don't understand. That money wasn't just sitting in a vault. If it had stayed in your account, it would have generated its own returns, its own dividends, its own compound growth. So the real cost of that 0.47% fee isn't $92,670 in lost portfolio value. It's $92,671 plus all the future returns that money would have generated. If we factor in that your portfolio could have continued growing at 7% annually after that 30-year mark, that $92,671 represents a loss of roughly $300,000 in true generational wealth. Let's break down why this happens. Expense ratios are expressed as percentages, but they're charged on your entire balance every single year. Year 1, you have $100,000. You pay 0.55% equals $550. Year 5, your balance is $140,710. You pay 0.55%, $774. Year 10, your balance is $198,359. You pay 0.55%, $1,091. Year 20, your balance is $393,646. You pay $2,165. Year 30, your balance is $761,125, $187. Total fees paid, $47,929. But here's the psychological trick that financial institutions use. They hide this behind percentages. They say it's only 0.55%. And your brain categorizes that as negligible. Your brain does not instinctively understand that paying 0.55% on a growing balance over 30 years equals nearly $50,000 in hard dollars. Now let's talk about the ETFs that most of you should actually own if you care about dividend income and wealth building. Schwab US Dividend Equity ETF, SCHD 0.6% expense ratio. Vanguard High Dividend Yield ETF, V.08% expense ratio. Vanguard Dividend Appreciation ETF, 0.06% expense ratio. Invesco QQQ Trust QQ 0.20% expense ratio. Vanguard Total Stock Market ETF, VTI 0.03% expense ratio. Notice the pattern? The best wealth-building ETFs are all under 0.10%. And here's the thing. They're not underperforming. They're not riskier. They're not worse quality. They're literally the same funds, but structured efficiently. So why would anyone choose 0.55%? Because their bank sells it. Because it has a fancy name. Because it promised them active management and professional oversight. All code for, we're going to charge you more money to underperform. Let me show you another shocking calculation. If you're 30 years old today and you invest $500 per month into a dividend ETF until you're 65, that's 420 months of contributions, about $210,000 total. With 7% annual returns, you end up with roughly $1.2 million. At 0.08% fees, you take home $1,180,000. At 0.55% fees, you take home $150,000. Difference, $130,000. For the same work, the same market exposure, the same dividends, just a fee difference. This is why fee selection is one of the highest impact decisions you make as an investor. Higher impact than trying to pick individual stocks. Higher impact than timing the market. Higher impact than sector allocation, because fees are the one thing you can actually control. Here's your action plan starting today. Step 1. Open your brokerage account. Pull up every ETF you own. Write down the expense ratio for each one. You'll find this in seconds on the fund's profile page. Step 2. If any of your core holdings have expense ratios above 0.25%, do research. Ask yourself, why am I paying this much? Is the performance difference worth it? Spoiler, it almost never is. Step 3. If you find a fund that's charging you 0.50% or higher, start planning your exit. This doesn't mean sell everything tomorrow. Tax loss harvesting exists for a reason. But if this is in a tax-advantaged account, a 401k or Roth IRA, switch immediately. No penalty. No regrets. Step 4. Going forward, when you buy a new ETF, make expense ratio one of your top 3 decision factors. Top 3, not an afterthought. For dividend income specifically, I recommend building a core around SCHD, VYMI, and maybe adding VRO depending on your strategy. All are under 0.1%. All have proven dividend track records. All are going to let you keep the money you actually earned. The difference between 0.3% and 0.55% isn't academic. It's real. It's generational. It's the difference between retiring at 60 versus 70. Between leaving your kids $500,000 versus leaving them $600,000 plus. Expense ratios are the one